Great. All right. So let's get started. So I am delighted to be joined today by Petra Gerlach, who's the head of monetary policy analysis at the Swiss National Bank. I've come across some of her academic papers in the past, especially on monetary policy transmission and macroprudential regulation, and they're a great read for anyone interested in the topic. So as Ellie just mentioned, we'll start with a short presentation on the SNB's response to COVID-19 and its grappling with the nascent recovery, and then I'll ask a couple of questions, and then I'll open it up to the audience. Ellie has just notified me that we already have audience questions, so we'll jump into those as soon as we can. So I'll hand it over to you, Petra, and looking forward to your presentation.
Okay, thank you very much, Pierre and Ellie, for organizing this, for asking me to be here. It's really a pleasure to talk to you about the impact of the pandemic on Switzerland. I should start out by saying that the usual disclaimer applies. I'm showing obviously SNB data, but the views expressed are my own. And I've prepared a couple of slides just to show you graphs on the impact, explain a little the policy response, but it'll take about 20 minutes at most to go through these, and then I'd be happy to take questions and discuss with you. So let me start out with, there we go, a little lag here, with the infection numbers. This is the international comparison. In my graph, Switzerland is always the blue line. These are now, to make numbers comparable, cases per 100,000 inhabitants. And you see that Switzerland has had a large number of infections. We were high in the first wave of the pandemic, starting early. That's a proximity to Italy. The second wave, last fall, we had very high infection numbers, and we are now seeing an increase in numbers again. That's a third wave hitting us. So that's the infections. Also, there have been many deaths, so the human toll of the pandemic has been very, very large. I'm going to focus on the economic impact, and for that, I've again, using the same colors, brought a comparison with the other countries. On the left-hand side here, you see the drop in GDP. This is in levels. I've normalized the last quarter before the onset of the pandemic to 100, and there you see just a drop in GDP for these different economies. And obviously, China is steaming ahead, recovering very strongly. Switzerland has had historically seen a very large drop, but by international comparison, we've been doing comparatively well. Part of this probably is simply that we have a lot of jobs in Switzerland that lend themselves to remote work, but we also think that the measures taken by the government and also by the central bank have helped limit the crash we saw last year. So the impact of the crisis you see very well here on the right-hand side in a graph on the Swiss labor market. In light blue, there you see the unemployed people seasonally adjusted in their thousands. Unemployment as a percentage has increased from 2.5% at the end of 2019 to 3.5% a year later. It's currently decreasing slightly. But what you see is the enormous peak here in short-time work. This is an automatic stabilizer in Switzerland, so nothing had to be prepared for this. Firms could just request this short-time work, and you see we crossed the 1 million people line here. Switzerland has a labor force of a little above 5 million people. So we had a very large number of people in the first wave in short-time work. These numbers are currently going up again. This is the third wave hitting us here, second and third wave here. So you see this automatic stabilizer has been very important for firms to bridge some of the liquidity needs they had, for households to get the security that they still earn money, that they won't be laid off, and that has reduced uncertainty a lot. We think that that is a very important factor. The Swiss National Bank doesn't only look at real number, but also at nominal numbers. That's my next slide here. I have on the left-hand side graphs on the Swiss exchange rate and on the right-hand side inflation. The left-hand side is plotted in such a way that it shows how many Swiss francs I need to pay for foreign currency. So when the lines go down, the Swiss franc appreciates. I need to pay fewer Swiss francs for 1 unit of the other currency. And you see Switzerland as a safe haven. Here you see it most pronouncedly for the UK, but also for the US, and more continuously for the euro area, the appreciation we saw at the onset of the pandemic. That's typical movement when there's a crisis. People want to hold Swiss francs, and we had a really strong appreciation. Taking everything together was in the order of 5%, and I'll show you later on that the Swiss National Bank actually took measures to limit this appreciation. It would have been much stronger without what we did. You also see that the situation has recently stabilized again. So we take that as a positive sign of the economic recovery that's taking hold globally. Now, the exchange rate for Switzerland as a small open economy matters a lot, because when we appreciate, it gets harder to export, that slows down growth and pulls down inflation. That's one channel. The other channel is the direct channel through import prices. When things abroad get cheaper, inflation in Switzerland falls. And you see that here on the right-hand side, inflation turning negative right at the onset of the pandemic. It's inching up now towards the zero line. We should soon cross it, but clearly below zero, where the Swiss National Bank has as mandate to guarantee price stability, and we aim to keep inflation between 0 and 2%. We don't always manage when there are large shocks. It takes a little while to come back, but you clearly see that there was a strong need for monetary policy to be expansionary. So let me talk about the measures taken in Switzerland. And let me concentrate on the federal government. There are also cantonal governments. Let me concentrate on the federal level and on what the Swiss National Bank has done. The first measure by the government, you saw that, has been short-time work, very important, kicking in really fast. The second measure has been a loan guarantee program, and I'll talk about that in the next 2 slides. That has been very important. And more recently, there have been hardship measures where the government essentially gives money à fond perdu, sort of as a subsidy to firms that have been in trouble because of the pandemic and the measures taken against it. That's the federal government. The Swiss National Bank has had 3 elements to contribute to the recovery. The first was to support credit supply. In a crisis as this, banks tend to get hesitant to supply credit, and the Swiss National Bank has contributed to this not happening. The first measure is the COVID-19 refinancing facility that worked in tandem with a loan guarantee program, and I'll come back to that. Second measure supporting credit supply has been an increase in the exemption threshold. That concerns our negative interest policy. Banks have to pay interest on the reserves they hold with the Swiss National Bank, but not on all the reserves. There are certain volumes exempted, and we have increased that exemption, by that making life easier for banks and supporting credit supply. And the last thing we've done also with exactly that aim, that banks have more room to maneuver in terms of credit supply, is we've asked the federal government that they deactivate the anti-cyclical capital buffer, which they have done that. So that's the first element of our measures from the central bank side. The second is low interest rates. Low interest rates make it possible for public and private entities that are in need of financing to get cheap financing. And then finally, I mentioned them already, the FX interventions to prevent an appreciation of a further appreciation of the Swiss franc, and thereby prevent the further tightening of monetary conditions. So this loan guarantee program, how did that work? Who was involved in this? It was a cooperation between the federal government, the commercial banks, and the Swiss National Bank. And it was set up really fast. That's, I think, an advantage of living in a small country. How did this work exactly? The federal government issued loan guarantees. So firms that were in need of credit given by banks, got a full guarantee on their loans. So if the firm, after the 5 to 7 year maturity of these loans, is unable to pay back the loan, the government will give banks this loan. There was a 100% guarantee for smaller loans. Those are loans up to £500,000 Swiss franc. And those loans had an interest rate of 0%. So they were cost neutral for the firms. That made it very attractive. Now, if you're a larger firm, the Swiss government doesn't guarantee everything. It guarantees only 85%. Interest is positive 0.5%, but still, this is much below market rates. So that's a part of the government. If firms are unable, after these loans mature, to pay back the loans, the government steps in. The part of the banks was to provide the loans through the existing infrastructure, and that's something that's been really, really important for the speed with which we've been able to implement this program. And the last element of this package has been the SNB. Somebody has his microphone on. Sorry,
could I ask everyone to mute themselves, please, if you're not speaking?
Thank you. The last element in this package has been the SNB with this refinancing facility, our CRF. Now, what is that? Well, if as a bank I supply a lot of loans in this program, and then I have to execute all the payments the firms that got the loans want to make with that new money, banks need to have enough liquidity to do that. They need to have enough reserves with the Swiss National Bank. And we provided this liquidity, taking the guaranteed loans as collateral. So if as a bank I issue a loan of 100,000 francs, I can come to the SNB, pledge these 100,000 francs in loans and get 100,000 francs as reserves with the SNB. The interest rate on that was set at the SNB policy rate, at our negative interest rate of 0.75%. So that means that for the bank, this refinancing facility is cost neutral as well. They don't have to pay negative interest on the money they get through the CRF. So cost neutral for the bank, cost neutral for the firms with the zero interest rate they pay. The government will have to pick up any loans that cannot be paid back in 5 to 7 years. So that was a program, and it worked extremely well. I show you here on the right-hand side the number of loans over time as they were issued. We announced the program on the 25th of March last year. The first contracts were approved the day after. So we had a really fast system, which enormously reduced uncertainty and which was really taken up very broadly as well. A fifth of Swiss firms participated. And what we see as a big success is that that money reached also firms that normally, when there is a crisis, when banks become hesitant to provide loans, that those firms got money as well. That's young firms and small firms, firms that are normally poorly documented and find it difficult to get credit. You see that in the average loan size, which was just over 100,000 Swiss francs, so very small in terms of normal business loans. If you add up the 130,000 firms participating, the total sum of COVID loans was 1.7 billion Swiss francs. That's almost 2.5% of GDP. And 2/3 of these loans were refinanced at the SNB. So that was additional liquidity we put into the system. So that was this first element of our policies, making sure credit is supplied, that we don't get a credit crunch. The two other elements, I mentioned them, are the low policy interest rate and our willingness to intervene in the foreign exchange market. So on the left-hand side, I've just plotted the relevant policy rates internationally, and you see that the Swiss rate is the lowest, so financing conditions are favorable. But you also see that we did not cut interest rates at the onset of the crisis, as was done in the UK and in the United States. Instead, we used another tool that was the FX interventions I mentioned before, to prevent further, or to reduce the pressure on the Swiss franc to appreciate. You saw in the graph before that the Swiss franc did appreciate, but it would have appreciated much more without our measures. And you see that simply reflected in our balance sheet size. The balance sheet increased a lot since the onset of the pandemics. Of this increase, 110 billion Swiss francs were interventions in 2020 to prevent a further appreciation. So that have been our measures. Looking forward, we expect the Swiss economy this year to grow between 2.5% and 3%. You see that also reflected in our inflation forecast. We expect over the coming months to get into the positive territory again, with inflation ending around 0.5% at the end of this year, and also staying within the range of our definition of price stability thereafter. So that would have been my introductory slides.
Great, thank you very much for walking us through the main pillars of the SNB's response. I think let's start with a question on negative rate policy. Obviously, the SNB is one of the only major central banks that did not cut interest rates. You relied on your balance sheet and other tools to stabilize the COVID-19 shock. You've written quite a bit about monetary policy transmission, especially the bank rate setting channel. And I'm wondering if you can walk us through the SNB's or your thinking on negative rate policy. How effective are different channels? How do you think about the trade-off between pass-through and the burden that it places on banks, and maybe a little bit about your experience with tiering, possibly in comparative perspective with the ECB and the BOJ. How effective has tiering been in your experience? What have you learned from other central banks' approaches to it? So why don't we start with that broad, very broad question on negative rates.
Okay, that'll keep me busy for a while. You stop me if I talk too long. Okay, starting out with the observation that we did not cut policy rates. Yes, absolutely, you're right. The ECB didn't either. So it's not that sort of with the one odd central bank, but we are in good company here. Now, how do we think about the negative interest rate? For Switzerland, it's the appreciation is something that has really troubled us since the onset of the global financial crisis. Switzerland has again and again, after these negative shocks we've had, been used as a safe haven currency. And while that is flattering to some extent, it is a real economic problem because it just slows down growth. It makes inflation, as you saw this time again, fall below zero. And our mandate is to safeguard price stability. So negative interest rate is one way to make Swiss franc investments less attractive. That is sort of the main consideration for us. So when we think about negative interest rate and the transmission we aim for, it is really the interest differential against other currencies. We're thinking of the transmission to the money market and from there to the capital markets. That's what matters for international investors. And with international investors, I mean investors abroad, but also investors in Switzerland. The Swiss franc for them obviously is also a currency that is attractive. So perhaps in contrast to other central banks, we have not been thinking of the negative interest rate as a way to encourage lending, the credit supply channel. You want to think of credit demand, credit channel, sure. But for us, it's really the transmission to money and capital markets. And that is something that has worked really, really well. When we cut interest rates the first time here below zero in 2014, and went out for the first time in 2014, and it became effective in 2015 after we discontinued the minimum exchange rate against the euro. You saw that transmission to money and capital markets really, really fast. That worked very, very well. Of course, the negative interest rate, as you've mentioned, is a burden on commercial banks, because how do we implement it? It's commercial banks that have to pay this interest on the reserves they hold with us. Now, we do not charge the negative interest on all the reserves the commercial banks hold with us. I mentioned before that we increased last spring the exemption threshold. So before we introduced the negative rate, we were aware of that banks had very large reserves with us, which partly just reflected the foreign exchange interventions we did. If you see here how our balance sheet increased, that was when we intervened against other currencies just to make sure that the Swiss franc didn't appreciate excessively. This increase in our balance sheet is directly reflected on the balance sheet of commercial banks. So their reserves had increased a lot since the onset of the global financial crisis. And so when we were thinking about introducing the negative interest rate, it was very clear to us if we apply that negative rate to all the reserves, it would become extremely costly for commercial banks. And that's why we introduced this exemption threshold, which means that a large part of commercial banks' reserves are charged zero interest. It's only a fraction that is subject to the negative rate, and it's enough to charge this fraction to make sure that that negative rate gets translated one-to-one to the money markets. That's what we wanted. That was the idea, but we try to keep the financial burden on banks as small as possible. We have to charge them, otherwise we don't manage to get market rates below zero, but with the exemptions we try to limit the costs for them. So from that point of view, there is, I should say, you were talking about the trade-off between the pass-through and the burden on banks. There is a certain room of maneuver where we can reduce the burden costs for banks without having a trade-off with transmission. It works if we only charge negative interest on part of the reserves. Yeah, that has worked. That has worked well. We have increased the exemption threshold. I mentioned that we increased it last spring. We also increased it the year before, 2019, just to account for the fact that we had to intervene a lot in the years that followed the end of the minimum exchange rate. And because of that, the reserves banks hold with us had increased, and also the cost of the negative interest. So yeah, so how exactly do we calculate this threshold? We tie the threshold to the minimum reserve requirement of the individual banks. This minimum reserve requirement mainly reflects how many deposits a bank holds. And our thinking is that tying the threshold to the deposits, the client deposits at a bank, makes good sense, because banks need to hold reserves to be able to execute the transactions their clients want to make with their deposits. So that's why we took the minimum reserve requirements as sort of the basis of the calculation for the exemption threshold. There are two things that are special with our setup when you compare it to the ECB. I should say the Bank of England, the Bank of Japan, I'm no expert on. They do it differently from how we do it in Europe, so I'd rather not comment on that, so I don't say anything wrong there. The ECB also uses the minimum reserves requirements like we do. They also use a multiple. I think it's 6 times the minimum requirements. We're currently at 30, but partly that just reflects that the balance sheets have been increasing so much in Switzerland. There are two important differences. One is that the ECB uses current minimum reserve requirements, whereas our setup, which has been in force since 2019, uses a 3-year average. The thinking behind that is that obviously banks are able to influence how many deposits they hold, thus what their minimum reserve requirements look like, thus what threshold, what exemptions they have. And with this 3-year average, we put inertia in there. We reduce the incentive to optimize. That's one difference to the ECB. The other difference is that if as a bank, you decide to hold cash in your vault, because cash isn't charged negative interest. That may look like a very good idea. In Switzerland, if you do that as a bank, it automatically reduces 1-to-1 your exemption limit. As far as I know, they don't have that at the ECB. Those are the two differences. Those are minor differences, let me say that as well, but those are the differences. And I think the transmission to capital, money market and capital market rates works very well in Switzerland and in the euro area. Let me stop here and give you a chance to.
Yeah, I like your point about tiering as a way to circumvent the trade-off between transmission and the impact on bank profitability. I'm wondering, just before we do, we have a number of questions from the audience. Just before we turn to those, I wanted to touch on the kind of the international dimension of your monetary policy. Obviously, in the US, you've seen already quite a strong incipient recovery, and that's been accompanied by a rise in yields on US Treasuries. The Biden administration is planning further fiscal support, and I'm wondering how you, as a small open economy, how you think about those potential spillovers from the US and to a lesser extent from elsewhere. How do those impact your thinking around policy setting?
Okay, a small open economy, when the rest of the world grows, we benefit from that. So we're very happy to see these developments. So one is simply sort of the transmission of growth. If there's more growth abroad, then there's more demand for Swiss exports. That gets translated directly. The other effect, if growth in the US becomes so strong that the Fed at one point starts to raise interest rates, that also helps us on the exchange rate, because the dollar will become more attractive as an investment currency. It probably is already becoming now more attractive, but we've seen much less pressure on the Swiss franc to appreciate these last months. And that helps us on this front as well. So we have these two effects: growth, spillovers, and then the spillovers through the interest rate differential, which might materialize.